Hi, and welcome to Crypto for Advisors, a podcast by Synergist. More than a third of Australians are into crypto, yet nearly 90% of advisors will not discuss it with them. I believe this is exposing investors to unnecessary risks, compromising the value of advised relationships, and limiting investment performance. My goal is to educate advisors and investors to bridge this crypto service gap while strengthening advised relationships. So let's get into today's episode. Welcome to Crypto for Advisors. Today I am joined by Ryan McMillan from Merkle Tree Capital. Ryan is a fund manager who applies the rigor and discipline of traditional equities investing to the world of digital assets. At Merkle Tree, he invests in blockchain companies and cryptocurrency tokens through his managed funds, bringing a structured and institutional approach to this emerging and innovative asset class. So I'm looking forward to unpacking his perspective on how traditional investment principles translate into the cryptocurrency space. Ryan, thank you for joining me on the podcast and welcome.
Thanks, Andrew. Great to be here and chat. Always happy to chat digital assets.
Indeed. And Ryan, we were just chatting before that we've both come from that traditional finance background and then have, drunk the Kool-Aid, I guess, and opened our eyes to the world of crypto and blockchain technology. And it's very hard to sort of look back once you see the potential and you see the opportunity. Do you find it hard relating to some of your previous peers who haven't made that transition, haven't educated themselves yet? Do you find that there's a distances forming?
Yeah, absolutely. We've gone down the rabbit hole, and there's no way back out the rabbit hole. So once you know certain things, it gives you a perspective on other things that are thus informed. So whilst I can see the perspective of my TradFi colleagues, I do feel we were all indoctrinated into a certain way of thinking, and that's around inflation and diversification and risk management particularly, or not even risk management, but some volatility. That volatility is a bad thing. And I think now through this process, volatility can be a good thing. Volatility can drive returns. It's not something we should be fearful of. And you've got that really different perspective. So it's always about trying to help and hold hands and walk them through the process. It's always a different element that people go, have their moment to sort of, start to unpack and start their own journey.
Yeah, I find that probably, well, I won't say what percentage, but a large number of people that I speak to, you just straight away know that they're just not going to make that transition into this asset class. They're just not open to it. And that's okay that it's outside their comfort zone for whatever reason. There's no point really trying to convince them. So this podcast is really aiming for the other 50%. There you go. I said the number, who actually want to educate themselves and want to learn and take the orange pill or go down the rabbit hole or whatever it is that we've done. But Ryan, you also, from the first time I met you, what struck me is that you share a similar philosophy to what I've tried to maintain, which is that I look at the traditional finance market that we came from, or industry that we came from, and I see so much value in it. I see the important role it plays in society, and I want to try and retain as much of that to this new asset class, whereas a lot of other people will just sort of, throw that out the back and just charge boldly towards the horizon in a whole new way. And I see that in the same way, the way that you're running things at Merkle Tree. It seems that you are still retaining a lot of the elements of traditional wealth management and investing. Can you talk us through your approach there and how you've managed to bring a new asset class into that way of working?
Yeah, so my background's portfolio construction, and I do still keep a very traditional view on that you've got a new asset class here. It is uncorrelated in ways. It spends time correlated and uncorrelated, but either way, correlations are always moving. Being uncorrelated, therefore, means you can add it to a portfolio and enhance your risk-adjusted returns. And that's ultimately the holy grail of what we're doing. So we don't get new asset classes very often. Here we've got one. Now it's just about position sizing and sort of understanding what's your risk profile and risk tolerance, and therefore how much can you allocate to this new asset class. So whether that's 1 or 2% for most people, we think that's a great place to even just dip your toe. You can have a meaningful impact on your Sharpe ratio and or your risk-adjusted returns, if you like, with really minimal impact on your volatility. That 1-2% really can't get you hurt, but given the history of the asset class, has really helped portfolios out as well. And we think that's starting to move from the 1 to 2 maybe last cycle to 3 to 5 being more and more normalized. But it's certainly not going 90% or all in. It is, position sizing and starting with 1%, if you will.
It's an interesting challenge because traditionally when you look at risk-weighted returns, you're looking at volatility, and volatility is measured in decades, mapped over decades of longitudinal data sets, 20 to 70 years. If you're an asset consultant, you kind of, that's the framework that you're kind of working in. This asset class has been around for, let's say, 15 years. And so we don't have that longitudinal data. And even the 15 or whatever, 17 years now, whatever it's been around, how it was even 2 years ago is significantly different to how it is today. How it was 5 years ago, completely different. How it was 10 years ago is completely unrecognizable. So the longitudinal data is largely irrelevant. If you're looking at it from a portfolio construction point of view, that volatility is shifting so rapidly as the investment behavior changes towards Bitcoin. I'm talking Bitcoin particularly here. But how do you manage that? How do you build in that dynamic nature of crypto? Because, ultimately positioning for the future, and the future is looking very different to the past.
Yeah, it's a really good point. When we started testing the portfolio, we started using backward-looking data, so using a Markowitz portfolio style to bring a sensible portfolio together. But we found, some of those assets only have 1 or 2 years history, and it just really wasn't all that useful. So whilst we had a grounding in that, it really does have to be a lot more forward-looking as well. And there's a little more art, therefore, coming into that portfolio construction. It's not all science. We like to think about being where the puck's going to be rather than where it is, and that's a really smart way to invest in technology as well. A lot of technology exposure comes through the VC sector as well. It doesn't all work, but the things that do work really well, and having small allocations can make a big impact. For Bitcoin, if we talk about that, it's what can you do with Bitcoin? What is the use case? Why would people use it? Why would central banks be putting more and more gold on their balance sheet? Then it's not hard for me to extrapolate that they might like another store of value that's potentially a little more sensitive to money expansion, like Bitcoin.
There's a few things in there. If we stick with the volatility just for a bit, and we can come back and talk about Bitcoin and the factors that are driving change or, price appreciation, hopefully a bit later. But from a volatility perspective, I was looking at volatility. I've been thinking a lot about volatility lately, and because I think the traditional wealth management sector see volatility as something to be avoided, whereas the crypto community see volatility as something to run towards rather than run from. And so there's a real psychological divide there, and age, I think, plays a large part of that as well. Have you got more wealth that you need to protect and maintain, or you have less wealth and you just want to focus on growing, and you've got a much longer timeline that you can take that risk with. So there's a risk profile obviously play into that. But despite that, when you look at volatility and you compare, say, Bitcoin to the Mag 7, the Bitcoin volatility has actually been less than some of the Mag 7 this year, calendar year to date. And even just Bitcoin compared to the S&P, it's kind of almost comparable, from a volatility point of view. It depends on how you want to measure your volatility, what timeframes. So do you think that the volatility in Bitcoin is shifting, and what do you how do you compare it to today, and where do you think it's going to be in 12 months or 2 years from now?
Yeah, it's certainly been coming down for quite a while. And I think a really big driver of that has been certainly been the ETF. So they obviously opened up huge capital markets to Bitcoin. There's a lot more buyers came in from the institutional side. That has really dampened volatility. We haven't had the big sell-offs that we've had in the past. I mean, we are going through a pretty mild sort of bull market for the last few years, where we've just been trending up, volatility reducing, like you say, less than the Mag 7. But those wild volatility days seem to be written in the history of Bitcoin, and certainly not really looking like they'll be a part of the future of Bitcoin. Having said that, we do hope the bit of volatility stays there, because otherwise you're holding, a cash, if cash has no volatility, it's actually, from a Bitcoiner's point of view, it's losing money because we know inflation is there. Without volatility or trying to really minimize volatility, you're getting zero return, if not actually going backwards. You need some volatility to keep your portfolio ahead of that debasing effect of inflation.
Yeah, and the forecast for the next year or two is you really need to be getting 6-7% just to tread water as a return, don't you? That's the modeling that I've seen. So obviously having a scarce supply of 21 million Bitcoin, that is potentially a hedge against inflation or the debasement of the US dollar, which is why a lot of people are seeing seeing Bitcoin as an attractive investment, just as that hedge or a long-term store of value that isn't going to inflate.
I was doing a presentation just this week on exactly this issue, and we haven't seen real bouts of inflation since the 70s. So it's a good time to say, okay, well, how do different assets behave during periods of sustained inflation? And so we've got really good data, and we can look at the 70s. So what happened in the 70s? Gold annualized at around 33% over about a 10-year period. So huge returns. Equities and treasuries did 5 to 6% each, whilst inflation was moving at around 7%. So they both lost money in real terms. We think it's not a bad idea, and so do a lot of great macro investors like Stan Druckenmiller, Tudor Jones. Ray Dalio recently came out, and they're really positioning away from the bonds in their portfolio, which don't perform well in inflationary environments, into hard assets, and that they are predominantly gold and Bitcoin were the ones that are recommended by these guys, and we think that's really sensible, and it's something advisors really need to have a good look at as well. The 60-40 has worked really well for the last 40 years, whilst we've had this bond bull market going on, which has meant inflation has been slowly and consistently dropping, and now that's reversing. So we think that whole portfolio construction thesis needs it to be revisited at least.
The interesting piece to that to me is that these legendary investors, that they're actually putting Bitcoin in the same camp as gold. Now, some of them still weight gold more heavily than Bitcoin, absolutely. But they're all saying, yeah, Bitcoin is a legitimate hedge against inflation and it's a long-term store of value. It's a similar investment in their mind to gold, which is amazing part of the Bitcoin story to have reached at that threshold. And I think that a lot of the the investment market is yet to catch up with that and actually adjust their mindset to see it in the same way. They still see it in the Jamie Dimon pet rock category.
No, that's right. And the US is probably a couple years ahead on that journey as well. Larry Fink has certainly popularized that digital gold narrative, and that's worked really well. And that's why it's getting those 1-2% allocations. And now we're starting to see Ethereum finally be understood, and I think it's being understood on the back of that use case of stable coins, where after we've seen the Genius Act in the US passing and sort of pushing and creating that framework for stable coins.
Yeah, I think it has. That's driven it. I think that the other thing with Ethereum that's driving it is the DeFi application, the ERC20s or the smart contracts, the ability for Ethereum blockchain to actually store smart contracts and facilitate autonomous trading conditions, which are really handy for decentralized finance applications. And with the Clarity Act due to be passed any week now, that unlocks a lot of interest from the retail banks in America to actually start custodying Bitcoin and then offering a range of financial services off the back of that, such as collateral, allowing their customers to use it as collateral for lending or other more sophisticated products like staking, etc. So hopefully the Ethereum story still has a way to run. And I certainly hope so. But I've got another theory that I wanted to run past you. I've been thinking about this for a while. I've been thinking, and it's to do with the Bitcoin volatility still, and then I promise we'll move on. But the theory goes like this, is that, like I said before, you've got two segments in the market. You've got the believers, the Bitcoiners, the people who are investing in cryptocurrency have been doing it for a number of years, maybe many years, and have built up considerable wealth off the back of that. And that's a significant portion of the holders of Bitcoin, that, not necessarily the OGs, but people who have been holding it for say 4 years or more. And then there's the new money, which is coming in, which is a lot of the ETFs that you spoke about, the institutional investments as well. And then you've also got treasuries, corporate treasuries, companies starting to hold it onto their balance sheet, etc. Now, if we think about that as two separate markets and you think about it from a risk on, risk off point of view, when you're in a risk on environment and you look at the macroeconomic environment and you say, oh, I believe it's a risk on environment, so I want to lean more heavily into those risk on assets, then if you're in the institutional side, then you're putting more allocation into Bitcoin, and that's a risk on asset for you. But if you're in the crypto side, you're actually taking your money out of Bitcoin and you're putting it into altcoins, onto the other tokens. Conversely, when you flip and something happens in the market and you think, oh, going back to risk off, you sell down your altcoins. If you're a crypto investor, what do? You don't put it into fiat currency or into the ASX. You put it into Bitcoin and you hold it in Bitcoin. Whereas institutional money, the ETFs, they'll sell it out of the Bitcoin and put it into gold or some other asset class. And so it just feels like that's an element of this smoothing out in the market is you've got this bifurcation of markets which are offsetting each other. And as a result, we just sort of smooths out that volatility.
Another thing institutional investors will do, they'll say, I want a 2% allocation for this portfolio. And these are big portfolios, so they're running them for, hundreds of clients, potentially with thousands of investors in them. So they're really big allocations, and they might say, okay, it's 2%, but every quarter they'll rebalance. So in a bear market, when that's going down, they're going to be buying Bitcoin as it's going down and topping that up. And conversely, taking some profit from it when things are going well. So again, that's going to further dampen the volatility.
Yeah, right. They've got their investment mandates they've got to hit, of course. Like you, maybe.
We do a similar process. We invest how we would personally, which is exactly that, using Bitcoin to adjust risk within the portfolio. So we want to be directionally exposed to Bitcoin. And when things are looking a bit toppy, we'll be buying Bitcoin and selling our alts, like you were talking about. And we want to give
So maybe let's talk a little bit more about that. So Merkle Tree Capital, you've got a fantastic reputation in the industry as a high quality fund manager. And tell us a bit about your investment philosophy and what funds that you operate.
Thanks, Andrew. That's kind words. We actually just ticked over 4 years track record last week, so that was a nice milestone for us. Building track record in this nascent industry is really important. We want to be there in a couple of years' time when advisors are ready to really start moving in, and hopefully super funds follow as well. And we'll have this great track record, which I think will be quite compelling at that time. Maybe my background's a little bit of relevance there. So TradeFi background, hedge funds and asset management. I spent a lot of time in London. In portfolio construction, I brought risk premier funds to the UK and started making these forward-looking risk-adjusted funds. Instead of using historic data, they were much more forward-looking at sort of rolled those out for a bunch of different wealth managers. So it was really strong portfolio construction perspective, which is where I came to Bitcoin to find it quite interesting. And my co-founder, Dean, his background's computer science. So he had a startup that was looking to monetize a little bit, and they came across crypto solutions to do that. Ultimately, he started building a digital asset treasury company 5-6 years ago, before it was a thing. I think it's only a pretty new term to use. I would have called what he was doing a quasi crypto fund within a company. Now you call it a DATCO.
Michael Saylor copied him.
Yeah, that's right. I think he might have. So Dean might have got there first. So he started talking to me about, how can we institutionalize this? How can we make it fit for our friends and family to invest in, and get our risk allocations looking right. And then we had such success with family and friends, we moved it to a wholesale fund, and that happened, 4 years ago, last week.
Fantastic. And so how structured is your investment philosophy? How flexible is it? And how do you identify what tokens you want to put into the portfolio?
So when we created the proposition, we wanted it to be the most conservative way for investors to access the space. So buy and hold. We're not traders. We're not buying in and out of things. We want to buy the best assets we can, put them in cold storage, and get some yield if we can from them through staking. We do that through cold storage. We want proven protocols. So the things in the top 50, top 20 even is where most of the portfolio sits. So we're not looking for speculative things. We're not looking for things with low liquidity or VC lockups, really conservative, no leverage. This is the way we would invest for our friends and family. Ultimately, that's what we were doing. So we
Yeah,
certainly
great.
don't want to lose any assets. We want to keep them safe and be holding on to what we think will be the most important parts of the sectors in 5 years' time.
Awesome. And how do you get the yield on it when it's in cold storage? Which do you use specific partners or applications for that?
Yeah, so we use Coinbase for institutional custody services. They've got a 12, 13, 14-year track record now, never lost any assets. So we think they are number one. We don't want to put our assets with, there are some newer ones and bigger names potentially, or more TradFi names. They don't have the track records. So we really like it where it is. BlackRock have chosen them, and most ETFs have chosen them as well. So we sleep well at night knowing that's where the assets are. Part of their solution is you can still stake through their cold storage solutions. You- Again, we sleep well knowing that they're locked up as safe as they can be, and also generating a yield of, the Solana 6 to 8% on a decent holding.
Right. And just for our listeners who might not be familiar with the term staking, but essentially that's earning interest on your holdings, right? It's like having a cash in a term deposit, earning an interest rate. I don't know what the interest rate these days on a TD would be, but maybe 3-4% or something. But you're earning more like 6 to 8% on depending upon what the token is.
That's right. So you're locking up your assets, which is a bit like a term deposit, is how it feels. You can't sell them at any, quickly. You need to unlock them, unstake them, and then you could sell them. It also secures the network a little bit like mining, but a different process to the Bitcoin network.
Looking at your current portfolio, what are the factors that you're currently got a finger on the pulse of? I'm talking about market factors as opposed to specific tokens. You're probably not able to talk about specific tokens that you're bullish on. I don't want to get into shilling territory, but what are the dynamics in the current market that you're watching closely to say, I'm going to see how that plays out because that may be something that I want to invest off the back of, change my portfolio off the back of.
Yeah. So our portfolio construction's got two elements to it. One's that fundamental bottom up, choosing what we think are the best assets. And then there's this top-down risk overlay. Part of that is the 4-year crypto cycles, which are sort of built around the Bitcoin halving cycle, and maybe also the US election cycle as well. We think there's good correlation between those two events. But ultimately, the biggest driver for Bitcoin price, which is also the main beta or source of beta for the rest of the altcoins. If Bitcoin's doing well, then altcoins can do well. So we concentrate a lot on what Bitcoin's drivers are. The main driver for us is liquidity, global liquidity. So, which is why it's an excellent monetary inflation hedge as well. It's more sensitive to monetary inflation than gold and any other asset. So when either central banks or high street banks are also the ones who create money. When they're creating money, we see M2 global money supply trending up. There's a pretty good correlation to where Bitcoin is headed. The top of the last bull market was late in 21. This was also the time Jerome Powell was out saying, we've got a problem with inflation. It's not transitory, and we're going to have to start changing our rate forecast and starting to increase rates. That's the sort of things we're looking at. It's really macro. We're also, as much as we're a crypto fund, we're really more concentrating and allocating like a macro fund.
There's an interesting dynamic around the to money supply and the correlation to Bitcoin price movement. Do you follow the theory around the 80 to 100-day lag effect and the correlation to that? And if so, where are you seeing that at the moment? They're still raising in an increasing monetary supply environment. It looks like potentially that increase might actually accelerate as Trump wants to debase the dollar so he can lower his 10-year bond yield so that the interest payment on the 36 trillion debt is affordable because it's cheaper plus it's relatively less. Do you subscribe to that principle around that lag effect? And if so, where do you see it projecting forward over the next couple of years? And not financial advice, just
No, not financial advice, of course. It's been uncanny, that correlation for the last 2 or so years that with a 90-day lag. We can speculate about why that is. I think gold moves a little more immediately, and then Bitcoin has followed a little bit later. They're the two assets who are most strongly correlated to M2. Potentially, central banks are moving first, and they're buying that store of value. Perhaps that trade gets a little bit overheated, and then money goes looking for another store of value, and that takes a bit of a lag of a couple of months, and they ended up that lots of that capital ends up therefore in Bitcoin. That's speculation, I guess. It has been drifting and trending higher all year. The last month or so, it's sort of tailed off a little bit, and we're wondering whether Bitcoin is now following that in real time. If you can see something that's 90 days ahead, but you can see it now, potentially that's why we're drifting sideways a little bit right now. But we're very comfortable with the current trend of rate cuts certainly being back on the cards in the US, going to further increase that money supply, and that's just the direction of travel, not only with central banks but also deficit spending as well. That's another big driver of monetary inflation. And when people say what could go wrong with Bitcoin, I think the number one thing that could go wrong is governments decide to balance budgets around the world. That would be a major headwind for Bitcoin price appreciation, but we're pretty comfortable with that where we sit right now.
Yeah, it doesn't sound like a likely scenario at the moment. So thinking about the M2 money supply correlation that's weakened over the last month, as you said, at the same time, the Bitcoin dominance index has also dropped, potentially as the industry's maturing other assets like Ethereum or maybe even Solana or XRP or are absorbing some of that liquidity as opposed to just Bitcoin. And we're starting to see a bit of a turn into alt season, of what the crypto insiders will call alt season, which is basically a more bullish sentiment within the crypto community that tokens other than Bitcoin are going to start accelerating. Do you think that could be a factor here? It's likely to be a factor here. And do you think that we're in alt season at the moment, or starting alt season, or what's your view on that?
Yeah, I guess we're cautiously optimistic. We're at the start of an alt season. Typically, an alt season looks like Bitcoin running really well, followed by Ethereum, followed by, let's say, blue chips. So if that's the case, we've certainly had Bitcoin and now Ethereum. Now, if we get Solana starting to run and other things in the top 10, then I think it's pretty safe to say it'll almost be a self-fulfilling prophecy that people will chase it down that normal path. So we're pretty constructive on that being the case. Solana's looking really good. It's about to get an ETF. What's different in this cycle is all of those more traditional flows, those capital markets, more institutional capital markets being open to the sector. So you don't have to go on through your Coinbase or Kraken account. This is money piling in through the biggest capital markets in the world, being the US equity market. So potentially a more sophisticated investor coming in, but larger flows of capital, and there's a lot of tailwinds behind the US administration right now, really embracing not just Bitcoin but crypto as well.
I should know this stat, but I don't. I know that Australia's the ninth largest or highest adoption of cryptocurrency out of any country, and at about 32% of Australians owning crypto. But I'm not sure what the penetration in America is, in the US. Do you know what the adoption rate in the US is?
I feel like it's pretty similar, or maybe a little higher. I think the places that have really adopted it are the ones facing more financial crises than others. So if they've had monetary inflation that's been out of hand, then Bitcoin's obviously been a safe haven for them as well. But equally so as the US dollar, which are now, both of those things are a lot more accessible given crypto markets themselves, really opening up more investment opportunities internationally.
Hmm. And do you think that the Clarity Act is going to have an impact when that comes through? You spoke about the Genius Act, the stablecoins bill, and there's obviously the Strategic Bitcoin Reserve, which was a bit of a nothing burger in the end, I guess. Got baked in at the election and then didn't really deliver beyond the minimal expectations. And then there was the anti-CBDC Surveillance Act as well, which went through. But the Clarity Act seems to be the big one, which provides regulatory clarity for institutions, corporates to enter into this space with their own products and services to retail customers in the US. Given that the US have adopted it a lot already, they've got a high adoption rate in a largely hostile regulatory environment of the past. Do you think that as that shifts and goes 180-degree turn under the new administration, what sort of impact do you think that's going to have on the US perception and behavior towards crypto? And how might that play out with crypto-based businesses that that are trying to create new value use cases in things like DeFi or real world assets, or changing up existing industries using this technology.
So just quickly on the Bitcoin strategic reserve, I don't think it's dead and buried yet. I think it's just being put on hold. I don't think you can strategically accumulate a lot of Bitcoin. You can't tell the world we're going to buy a lot of Bitcoin. Everyone will front run you. So I think they're looking at ways to do it. And the 6 months since they decided to go away and look at it, they've come back and said, yeah, we're going to look at ways to do it again. And we didn't
We're
really get
not going to tell you how we're going to do it, at least.
Exactly. We're not going to give our strategy away for our strategic reserve. So, stay tuned on that one. That'll be really interesting. And obviously, a market change. Other nations will almost certainly have to follow that. This will be a strategic asset, just like putting gold on a sovereign balance sheet as well. So that will be really interesting. And I think, how it will play out need a lot of thought, and I guess that's still happening at the moment. And all the states want to follow as well, and I feel like they've been told you're not allowed to go maybe until we go, or we all go together. So it does need some coordination. But on the clarity bill, I think what it really does is sort of move the power sits offshore in crypto markets in terms of market structure, and there's a little bit of manipulation going on there. The idea is to move that to Wall Street, making it the home of crypto, the US, which has been said a few times by Trump and admin. So we think that's the direction of travel. Again, that'll further reduce volatility.
So I can see some pros and cons of that. The pros, I think, is repatriating a lot of US companies that got driven offshore, bringing that back into America. I think it's going to be a really good thing. They should never have been driven offshore anyway. And so I think that just reestablishes the market to where it should be. And I think that'll be really healthy for the ecosystem and good from a regulatory oversight and governance perspective for the asset class. But I do worry that this movement of crypto towards Wall Street, it's kind of just seems to be blindly accepted as a positive. And I'm not so convinced it's going to be a positive, because if you look at what Wall Street does, it's not all positive. I mean, they're ultimately just money-making beasts. And if you look at,
Yeah.
there was the recent, I can't remember the name of the company, but it tanked because they realized that Wall Street had issued in all of these different instruments 140% of the available script. There's 140% of all shares on issue had been actually sold. It had been, somehow Wall Street just can manufacture these extra instruments that aren't even backed by anything ultimately. And then that all came crashing down. So Bitcoin, one of the great strengths of Bitcoin is its scarcity. And it's transparency, it's immutability. If you own that Bitcoin, you own that Bitcoin. And then if Wall Street come in and they start then creating all of these instruments off it, where you've got more than 21 million Bitcoin that are being sold into the market, that doesn't sound like a good thing to me.
No, it's not, and it's against the whole premise of the crypto industry and Bitcoin to really disintermediate and drive things on chain. And I think that they're the two most important things. There's going to be less reliance on banks in the future, because we're going to need them less and less. And things like stable coins, you don't need a bank account anymore. You can hold your stable coins, you can self custody them. And like you're talking about lending as well, you can be able to use your own assets that may well sit in your phone also as collateral. So their influence is certainly going to decline in that regard. And you're also going to see more acknowledgement of on-chain activity as well. So it's very well to say we've got more than 21 million Bitcoin, but we can see them on chain and say, well, there they are. You can't really make more than that, or they're paper Bitcoin and they don't have the same value as a real Bitcoin. So I think there's going to be checks and balances inherently in the system. In the meantime, whilst we get there, there's always going to be issues with paper assets. We've seen it with gold and other assets too.
Yeah, it's like people who buy an ETF, a Bitcoin ETF. Well, you don't actually own Bitcoin. You own units in a trust that holds Bitcoin, hopefully, and hopefully they hold as much Bitcoin as they're selling.
Some of those ETF providers do publish their on-chain wallets as well. So you can sort of do a little reconciliation yourself and see, and Bitcoiners can do that, which gives you a little more comfort, but not all of them do. Hopefully that's the direction of travel, more transparency, and that will certainly be a good thing for the entire TradFi industry.
Fantastic. All right. Well, Ryan, that's been really fascinating. One thing I'd like to just ask as a parting question, if that's okay, is if you're talking to an Australian financial advisor or accountant at the moment, and they said, look, I'm getting questions from my customers. I don't really know how to answer it or what to do. What advice would you give them? What would you say? This is what you can do. This is what you can't do. Here are some solutions.
Yeah, it's a real minefield for advisors. We understand that, particularly having a fiduciary relationship to somebody and then exposing them to this high volatility asset. You could get egg on your face, and I think that's been part of what's holding people back. And then the infrastructure of insurances and even asset consultants around the industry moving the right direction. We are getting there, but it does take a little bit of time. So we get invited into those meetings often when the client made up their mind and they're saying, look, I want some exposure to this asset class. That's when advisors have often invited us in to have a chat with them, saying, look, we can't recommend it, but if this is something you want to do, then here's one solution. ETFs are another solution. Active funds are another great solution. A lot of advisors like an active solution, and we think we can provide some alpha on the market through that. Our returns the last 2 calendar years are over 100%. So that's quite compelling. We've shown periods where it can really outperform Bitcoin and add some alpha. So we're always up for that conversation, and it is an educational process. I'm sure you do the same. You're always banging the drum and dipping the toe in the water, I guess, is how instos are approaching it as well, trying to get clients on that 1%, or if they want it, here's your options. And in the meantime, it's listening to good podcasts that you're putting out and others as well. And this is a real education focus. Advisors, particularly if they're under their age of 40, are going to naturally know more about this. So are their clients as well. So the young clients will have familiarity. They probably already hold some Bitcoin. So are these advisors, the younger ones, and it's a lot more comfortable that they're sort of waiting for their industry to catch up.
Yep. Fantastic. Well, thank you, Ryan. How can people find out more about Merkle Tree or follow you to keep up to date with what's happening with your organization?
Yeah, thanks. So we're pretty active on LinkedIn, and come say at our website, or you can come and find us pretty easily on our website, merkle.com.au, on LinkedIn. And yeah, always happy for people to reach out and have a conversation, understand what we're doing, get some collateral if they're interested, and have those conversations at the IC level or with clients, and just start that journey, which we know we're on that path. The more people we can get along board for the ride, the better.
I think what you said before is key. Education doesn't cost you anything. You're not committing to anything. You're just building your understanding of what's going on, what's this asset class all about. And then when it's the right time to dip your toe in and start investing or introduce your clients into certain pathways, then that will become evident depending upon your profile. But the education should be a no-brainer. It should be what everybody's doing. This is an asset class that is now established. It's not going away. It's going to only become more important.
No, that's right. We're a $4 trillion industry now, and that's growing rapidly, and we don't expect that to stop anytime soon. So yeah, it's a great opportunity to get involved in something forward-looking, future-looking, and we're having lots of great conversations, and yeah, always welcome new ones.
Fantastic. Thanks for coming on, Ryan.
Thanks, Andrew.
All right, bye for now.
That's bye.
This podcast is for informational purposes only and does not constitute financial advice. All views of Andrew McPhee and his guests are their opinions only and do not reflect the opinions of Synergist. You should not treat any opinions expressed as a specific inducement to make a particular investment or follow a particular strategy.